Hi, welcome to another episode of the Elite Wealth Podcast. I'm Patrick, and as usual, joined by Matthew and Victor here. Today, we're going to start off with the theme song of your life. So I'll go first, since I have one picked out, and maybe somebody doesn't have one picked out yet. But I'm still standing by Elton John. That's my theme song. So
I'll explain a little bit.
it would explain, if you know about my history.
You have to explain a little bit.
Oh, I have to explain a little bit? Well, if you're watching this, you can ask me and I'll explain deeper. I don't really want to get into it too deep, but I'll go off track and I'll get down rabbit holes, which we probably don't want.
Squirrel.
So, yeah, lots of squirrels. So, how about yourself, Matt?
I was thinking of a good one, and I was thinking about different artists I used to listen to. So I listened to Justin Moore a lot when I was younger. You know who Justin Moore is? Anyone?
I don't.
What the heck?
Is that Mandy Moore's brother?
I don't know. Probably.
I know who that is.
I don't think so.
Oh.
But he was a country singer, and he sang a song that was I gotta look it up to make sure I don't mess it up. How I Got to Be This Way. So he talks about his mistakes when he was younger, and then working off his debt, and just working through things, and made him into the person he is today.
Nice. Good one. So, Victor,
And now for Victor.
Victor wanted me to explain more so he'd have more time to think.
Well, this is a hard question for everybody listening. Trying to pick a song that describes your life.
Trying to organize all the Britney Spears songs in
All the
head.
Britney Taylor Swift songs. One that kind of
New
comes
artist,
to
Britney
mind.
Taylor Swift.
Yeah.
One that kind of comes to mind is "Red" by Hardy. You ever hear that one? It's a country song.
Mm-mm.
You know, because I really enjoy the small town living. I love America. Talks about the flag, all that kind of stuff. So I don't know. I like growing up on the quiet side. Big supporter of the country, all that kind of stuff.
Okay. Oh, very good. Well, in today's podcast, we're going to be talking about the different vehicles that you can use for retirement. So I think we want to start off first with income vehicles, and that's usually one of the things people think about is how do I take what I've saved and now convert it into income, and how does that exactly work? So let's just talk about some of the vehicles that we can use. And Victor, I'll have you start off with talking about annuities, and let's maybe talk a little about the good and the bad of annuities and maybe a proper allocation for them.
Yeah, so when it comes to annuities, and because we're talking about income on this show, let's keep it with the income annuities, because there's annuities for growth and then there's annuities for income. So if we look at annuities for income, generally what we're talking about most of the time, what we use here are fixed index annuities, and they have what are called lifetime income riders attached to them. That's one of the big tools we use to provide a lifetime income. And, we did a whole show on annuities and we took a deep dive into all of them, but I really like the fixed index annuities with some types of, income riders, long-term care benefits, all that kind of stuff, because what it does is it sets up a reoccurring lifetime payment for you and your spouse if you want to. So a lot of people like the idea of taking a chunk of money, putting it into an investment like an annuity with an income rider and saying, okay, I don't care what the market's going to do. I don't care how much volatility we have. I know guaranteed I'm going to get a paycheck every month. We call it mailbox money in my mailbox for the rest of our life. So just if you're someone out there who doesn't have a pension or didn't have an employer that offered a lifetime income when you retire, because I think they got rid of those or transitioned out of them in around 1997, anybody can take a chunk of their 401k, their 403b, and put it into an annuity that's going to generate you lifetime income. So that's the biggest benefit of not having to worry about the market, not having to worry about anything, and just saying, okay, I want $3,000 a month guaranteed for the rest of my life. And an annuity can do that for you. It can create you lifetime income, which is what we're talking about today on the show. Now, I would say the downside to that is when you move your money into an investment like that, you basically give up liquidity, right? So you can take money out of an annuity like that, but there's two things you have to watch out for. One is the penalty. If you take out more than the surrender free value or the penalty free value.
Yep.
So you have to watch out for that. And then two, if you were to take money out of that investment, they recalculate how much lifetime income you get every month. So it's something where we say, okay, I know I'm going to put this money in here. I'm going to get my monthly paycheck, but I'm never going to touch anything besides that monthly paycheck. Because if you do, there's probably going to be penalties and it's going to lower how much you get paid for the rest of your life. So it's a big decision you have to make. But in return, again, the benefit is you get a payment for the rest of your life guaranteed. And again, there's a bunch of different types of annuities that offer that. There's a few that we actually like to use here at the office for a multitude of reasons. But if guaranteed income, no market risk is something you're looking for, I'd say an annuity like that could be in the realm of what we invest in.
Yeah, and then I think comment a little bit on the variable annuities, because I think one of the things that I see people get misled on, I don't know if misled is the right word, as much as maybe misunderstand, is that these roll-ups, and we ran into that a lot earlier in my career when I'd meet somebody and they'd say, yeah, I'm getting a guaranteed 8%, or I'm getting a guaranteed 6% or 7%, and I get all the upside of the market, none of the downside, and at least 6%, which isn't how that works. And if that sounds like something you've heard, or the way it was explained to you, or the way you understand it, I would recommend getting a second opinion on it, because that's absolutely 100% not how it works. And that's really where some people have gone wrong. And you can get them both on the fixed index side doing that, and also the variable side. So you can get them both. Again, I think it's sometimes a little bit more kind of conceptually hard to get your arms around of how that exactly works, where they run this. My father always used to call it the funny money account that's accumulating at that rate until you turn on the income, but it's not real money. It's just that grows at a certain rate so that you get a certain withdrawal rate, and it ends up actually doing quite well. You get quite a nice payout for yourself. But expand a little more on the variables and maybe some of the pros and cons of variable annuities.
Yeah, so that specific with the variable, so the pro of the variable is typically you're able to capitalize when the market is up. You get a little bit more upside. So the market's up 20%, 15%, you might get something a little bit closer to that. Whereas the fixed index annuity, for example, might have a cap rate of 10%. So if the market was up 20% with the fixed index and your cap is 10, you only get the upside of 10%. Now, the big difference is with a variable annuity, if the market goes down, a lot of times your value can go down as well. And I think that's what people don't realize. So if the market goes down, you can either lose, they call it buffered, you can lose a certain percentage, maybe it's 10, 20, and again, every contract's a little bit different, or with the fixed indexed, typically you can't go below zero, so you don't lose anything, you don't gain anything, but you don't go backwards in value. And it's kind of crazy to me how many people come in and they have like a variable annuity, they've had it for 10, 15 years, but they don't actually understand how it's calculated. So kind of to Patrick's point, anytime someone comes in and they don't understand, I always go through the statement with them and say, this is how it's calculated. These are the different caps or restrictions associated with the policy. And then if they have the funny money, like Patrick's explaining, I'll explain, all right, you have an accumulation value, which is the money you actually have in the policy. And then a lot of times they have what's called an income account value. And that's typically getting, like Patrick said, a 6%, 7%, 8% rate per year, and it's growing. And then when you decide to, you can either take that amount out as a single life expectancy or joint life expectancy. And there's a calculation and all that kind of fun stuff. Every policy is a little bit different. But again, if you have any questions, let us know and we can walk you through what that looks like.
And I would say the other thing you want to look at is the spectrum of cost. Where variable is probably the most expensive policy out there because it has a lot of bells and whistles and a lot of features that, quite frankly, you probably never use. And then the fixed index, which is on a lower end of cost and expenses, but they can be expensive as well. And then the other one we didn't really touch on, which is something a little bit newer, is a buffered annuity. The buffered annuity basically is kind of like a little bit of a crossbreed between the index annuity and the variable annuity, where it does offer some downside protection through a buffering. So what that means is if the market drops 10% and you have a 20% buffer, nothing happens. But the market has to drop 30% in order for you to realize some sort of loss. And then a lot of times they'll just buffer. So what that means is that you'll not partake in that first 20% loss. So if it's down, market's down 30, maybe you only have 10. But then they also limit somewhat on the upside. They control how much you make on the upside. It's not totally uncontrolled, but it does, because you have some of that downside. You do have more of the upside. So it's an interesting product. It's something that I think you have to be patient to wait for. And that one, again, you can get those income features on there as well. Again, not to get back to the annuity 101, but it's just something that, again, on the income side, we see a lot of people drive income off of the annuities, the income annuities. And I would say, if I were to do a quick pro con of them, is that there's a lot of people out there that sell the annuity product. And they don't have a rhyme or reason why they're selling it, other than they're going to convince you that you should have this roll up and you don't lose money in the market when the market goes down, or what have you, and they're selling on emotion, the emotion side of it, and it doesn't I mean, I don't know how many times you guys have seen it, but somebody walks in and has one. It could be a great product, but there's no rhyme or reason why they have it. They just have it.
Mhm.
And there's no future purpose.
I would say a lot of times, I just was talking with a couple recently, they bought it because they were nervous about the economy at the time. And they were nervous, scared to death. If you talk to them now, I don't know if they still feel the same way just because things played out a little bit more. But they were so nervous about the economy that they just took a chunk of money, and it was kind of right time, right place, and they felt it was the right decision. But now they don't quite feel the same way.
Yeah, and it's. I'm not saying I'm not here to pass judgment on it. Just being aware as a consumer that are you working with somebody that is actually putting an entire plan together for you? Are they actually drawing up the entire plan, or is it
just one time?
The market's scary. It could go down. You don't want to lose money. You worked hard for your investment. Sleep insurance, whatever they want to call it. It just be aware of that, and that's their job. That's what they're there to do. And your job as a consumer is to make sure that it's in your best interest. Which again, being fiduciaries, we have to look out for our client's best interest. And then, Victor, did you want to add anything to that?
Yeah, the only thought I had was, pensions are basically annuities, as we've talked about before. So if you're someone who's retiring and you have the ability to draw a pension, a lot of the times you have the option to take a lump sum distribution instead of the lifetime payments from the company. Now, one benefit that we have at Elite Retirement Group is, we talked about this in another previous show, is we're an independent firm. So we don't sell annuities from one specific company. We can say, okay, we have X client that has $300,000. Who's going to offer us the highest monthly payment for the rest of our life? And we can shop around all the top insurance carriers in the country, which is really nice. So if you're offered a pension, well, before you draw that, let's actually look at some numbers and say, okay, could we take the lump sum amount that wouldn't be taxed if we did and move it to a different insurance carrier? Because your pension usually only offers their pension through one insurance carrier. We can shop all of those around to find, if any, a higher payment for you. So before you make any major decisions like drawing a pension, let's figure out that really is the best choice for you.
Well, now it comes back to the plan, right? Putting a good, solid plan together. If you don't have a plan for yourself, reach out to us. We're here to at least get you down the path, get you started, free consultation. You can either do that by visiting the website, or you can give us a call at 715-341-8899. We'd love to meet with you and see how we can help you out. Like I said, at least get you down the path of getting a plan in place, because that's really the critical part. Then you can see how these pieces fit together. And then sometimes, when you retire, maybe an annuity, maybe it is, maybe it isn't type of product that will fit best for you. Okay, life insurance. So I know this is Victor's favorite subject. So anybody who knows us, though, knows that, life insurance in the appropriate amounts we feel is good, but we aren't, I think sometimes people can be overinsured, quite frankly. I've seen that before. And so I'm a little bit hesitant on, big life policies unless it really, really makes sense. And I know it's Victor, because Victor, I had to do a little convincing here to make sure that if something happened to him, that his wife and child were taken care of, and his future child.
Take it with a grain of salt.
It's all good. It's all good. But life insurance sometimes can also be a way for you to be able to save for your own retirement. And really, this kind of speaks, it's not for everybody. Number one, let me just get it clear. It's somebody who's in a situation where you can't add any more to your retirement account at work. You can't add to your Roth IRA at all. You have a brokerage account that has a fair amount of money in it, and you're looking for tax efficiency in income in retirement. And that's really where that kind of starts to fit in, is somebody really has to kind of fit that profile. And life insurance can be pretty good. And Matt, you want to share a little bit about maybe a case study or some thoughts on that?
Yeah, so with life insurance, like Patrick said, a lot of, I don't think it's, one that we use extremely often, but in the right case, sometimes it does make sense. So to Patrick's point, some of the life insurance policies, more of like a whole life or universal life, where you can put money into those and get the tax benefit, and then use that cash value as it grows down the road to access when you're in retirement, is more of a way that people look at it. And then obviously, being a life insurance policy, if you're not with us, those proceeds get passed on to a spouse, kid, etc.
Tax-free.
Just to have that protection as a tax-free income. Now, one of the things we always do when people are getting near retirement, and when we're going through vetting the process and looking at a retirement plan for you, is trying to figure out how much life insurance do you have. Now, most people have life insurance through their work, but I would say a lot of people don't necessarily realize that it expires when they're not working for that employer anymore. So a lot of people, have paid off their debts. They don't have too much. We're not necessarily too excited about getting a big life insurance policy, like Patrick said. But if you do or need additional life insurance, just know that those policies typically aren't extended, and just planning ahead to get a better rate the earlier you plan by talking about it.
Yeah, and that's, I think, a big key for those policies that you're using for retirement. And I guess there's a little, I think my opinion is that with the time I've been in the industry, the very old policies, the whole life policies, were a forced savings plan. And they were talking about for retirement and all this other stuff. And it really never materialized to that, because in order to make it work, what you really have to do is you have to have a policy that you can do what we call max fund. So you want to every year be able to put the maximum amount of cash you can put in before it becomes a modified endowment contract. Not to get too far in the weeds, but basically there's a point where you don't want to put any more in. Otherwise, the proceeds become taxable when you start to take that money out through the loan process. And so there's a way definitely to do it. You want to max it out. Usually you want to have it all paid in the first 5 years. So I have a policy like that. Actually, my wife's policy, she has 2 of them like that. And it's just because we maxed out the other ways that we can save. And then we decided this was another route for us to be able to create more tax favorable income down the road for us. But you have to be careful with it. The other thing too is that when you're younger, if you're somebody who is maybe your career is on just a meteoric rise and you're doing really, really well for yourself and you have a lot of cash, sometimes this can be a great place to put the cash in the life insurance policy, because you can access it before 59 and a half without a penalty. So again, there's a bunch of different reasons why you want to do it. Potentially, it is a case-by-case scenario, but for the most part, I would say most people probably not doing cash value life insurance for retirement, not correctly. If you're going to pay it over your lifetime, probably not going to really work. I always said it's a 5-5-10 rule. So you want to fund it for 5 years, let it sit for 5 years, and then 10 years after that, you start taking the withdrawal. So really, you're looking at a 20-year cycle from when you start this to when you start drawing on this, to really get it to mature and to really get it to do what it's supposed to do. And if it's anything short of that, it's probably not really a great strategy for you on that end. So we're going to move on and we're going to switch gears and talk about dividends.
I had some thoughts.
Oh, okay. Well, you have thoughts, I suppose. I thought you had your one thought for the day.
I'll give my quick spiel on life insurance. Just forget about me. That's all right. No, all I'll say when it comes to life insurance is you have to figure out what the goal is, because with life insurance, you really have 3 options from a benefit standpoint that, I think that was like the first week you taught me about that when I started working here. So you have 3 levers. The first lever is your long-term care. The second lever is your death benefit. And the third lever is your income. So you have to figure out which levers you want to turn on and which levers you want to, turn down. A good case study is I had more of a high net worth client who's done really well for herself. And she had a index universal life insurance taken out when she came in to meet with me. And after looking through it, we figured out that basically she had all 3 of those levels right in the middle. So she had a decent death benefit, decent long-term care coverage, and decent income. And after talking with her, we decided and discovered that the only thing she cared about was income. It's one of her biggest retirement assets. So what we did is we actually 1035 that policy. We moved it tax and penalty-free from that index universal life insurance policy to a different one where we had the death benefit turned all the way down, we had the long-term care benefits turned all the way down, and we just focused on income. On top of that, she was paying like $20,000 a year in fees. So we were able to get those fees basically cut in half. So there's a lot of moving parts with life insurance. You have to figure out what the ultimate goal is, and there's still some good life insurance policies out there that can generate some good income in retirement. But generally, I would say if you're looking for income from life insurance, usually a higher income earner that, like you said, has a lot of cash, a lot of extra money to invest. They've taken advantage of their retirement accounts, like their 401ks or authorized traditional IRAs. But then basically when she retires, we're going to start taking loans from her policy that we don't necessarily have to repay, and it's going to generate her tax-free income in retirement. So we're going to be able to keep her taxes really low as well. But really, you just have to figure out, is your goal a big death benefit? Do you want to protect yourself from long-term care, or do you want the income? And based on that, life insurance could be a good option, or it might not be a good option.
Yeah, and I think you were hitting out with the levers there, because different policies do different things and are better at certain things. So some life policies have better, richer long-term care benefits. Some policies have bigger, better death benefits. Some policies have better cash accumulation. So just knowing which lever you want to be activating that's really what kind of determines what life insurance policy that is. But realistically, I would say that there's quite a few people that probably don't even know this exists, and actually probably quite good candidates for it. It's just something that has to be done right. It's something that it's not something you just buy today and, maybe you'll use it tomorrow or not. So there's some thought that needs to go into it for sure. So now do we have your permission to go on to dividends?
Yeah.
Okay, perfect. So we're going to talk about dividends and different ways you can get dividends. Dividends, predominantly what we're talking about is we're talking about stocks, mutual funds, ETFs, any kind of equities that have some sort of dividend. And what a dividend is when the company has a profit, they're going to share some of the profit with you because you're a shareholder. And there's many different ways to do that. You can get into high yield dividend stocks. You can get into preferred stock. So I think, should we have Victor explain preferred stock or Matt explain preferred stock?
Sure. Matt, you want to explain that one? Looks like he's prepared. Where are you going with that? The companies that pay a dividend, the companies that don't?
Well, okay, so sometimes when I'm hosting, I throw something at these guys. They're not quite 100% prepared.
All right, let me give it a shot.
And let's see if you.
So what was your question? The difference between common and preferred stock?
I just said, do you want to explain what preferred stock is?
So preferred stock, when you buy a stock, you can buy preferred or common stock, right? Mm-hmm. And essentially, preferred stock is if something wonky happens with the company, the preferred stock is going to get their dividends before the common stock, right?
Not exactly. So you have, yes, correct. No, I'm sorry, correct. You're correct. I was thinking when I think of it in a different order. So you're right that common stock is the least secure debt. Preferred stock is the next most secure, and then their bonds are the most secure. So when a company issues a bond, the bond will be the first debtors that get paid off if the company goes under, then preferred stock, yes, and then the common stock. So it just, sometimes you visualize it in your head, and I just visualize it. But you're right. You're 100% right. That's exactly it.
Where were you going with that?
Because we're talking about income. And knowledge. I mean, I don't think a lot of people know about preferred stock.
No.
I mean, it's a non-voting share. It pays a dividend, usually a pretty good dividend. It's a cross between the bond and the stock, really. I mean, except for you don't really hardly have any of the stock privileges. You just have the stock. You might get some options to go to a common stock, but preferred stock can actually be a great way to be able to produce income in retirement that a lot of people, I think, don't even look at or don't even think about. So I just wanted to bring that up because, again, we're here to bring you information and to help educate you and even to educate each other sometimes.
That's why I listen to Patrick. He's been doing it for 25 years.
25 years. Makes me feel old when you say that. So, Matt, what other kind of dividend producers are there out there? And we're going to stay out of the bond section for right now. We'll jump to that in a bit here.
Yeah, so like you mentioned before, I mean, regular stock can produce dividends, or even mutual funds or ETFs, exchange traded funds. Mm-hmm. So there's some ETFs that are really good and they produce a nice dividend, and typically they're a little less volatile. So good way to think about it, if something is more geared towards dividend paying, they're putting its focus on producing that dividend. You don't necessarily always get the big growth with it, right? But for most people that are interested in dividends, they like that because they want a more consistent payout. They don't want quite the same volatility. So that's where it can be a good mix in your portfolio. And then some people use those dividends to live off of, almost somewhat like a paycheck to receive and like I say, live off of in their retirement. A lot of people talk about them. It's not right for everyone, I feel like, to live off of dividends. And I feel like sometimes people think that's the way to go. Again, you got to look at your situation.
Does it feel like, and I don't know if you both can confirm this with me, but it feels like there's been a lot of talk by the pundits in the financial industry about dividend paying stock or dividend, yields and all the, buy some good dividend stocks and the problem is that I haven't really seen those stock companies do real well. They're maybe okay, but they went through a long bear market where they did really very, very poorly, where you're getting a dividend, sure, but you're also losing the value. Now, right. One nice thing is that, or the worst thing can happen, I should say, would be that they can cut the dividend.
They can shut it off overnight.
They can shut it off overnight, so you could possibly lose that, and then you'd have to go do something else. But so they're not obligated to pay that to you.
Yeah.
But another side of it is that when they issue that dividend, what happens to the stock price?
It goes down.
Down by the dividend. and eventually it'll pop back up. But it's just because it's basically like taking some of the stock and it's diluting it almost a little bit more in a roundabout way.
Right.
But that's why the price goes down and then usually comes back around. But dividends, I'm not opposed to dividend paying stock by any stretch. There's some, usually when you get into like the oil and natural gas, there's some very high dividend payers. You can get 10, 12% dividends. Real estate has some high dividend payers. You just want to be careful of what you're getting into and understand it. I just have found that the dividend payers just have, if you're looking for any kind of growth-ish, I'll call it, not great. And like you said, the dividend can be cut off overnight.
Growth, and then, like you said, one way I've heard it explained to someone where they had a dividend fund and they had it in a portfolio that was more aggressive.
Mm-hmm.
But how it was explained to them, they said, this usually produces about 10% based off the dividend, and then the fees of 3%, so it averages around 7% roughly over the course of time. They thought, okay, well, that doesn't sound too bad. Well, the downside was they didn't realize they couldn't really get their money out of that fund that they had it in. So again, it's just going back to, okay, they can be a good thing, but you understand the strings attached. Kind of like we talked about annuities and life insurance, they can be great things, but does it fit your situation based off of the strings that are attached to it?
Was that one a REIT?
Yeah. Real estate investment trust is, there was a company out there, a big company, if I said the name, everybody would know, that basically gave everybody a REIT. Mm-hmm. And there was a big class action lawsuit that came out of it, and that was years ago. But people literally lost all their money in the REIT because the underlying assets went defunct, and that was a bad scenario. Again, I think the big takeaway is if you're going to be in dividend payers, make sure you're liquid, and then you can do something different if you need to pivot. Preferred stock, again, is another way to go. I would say dividend yields on preferred stock haven't been super spectacular, so we haven't used them much. But I remember earlier in my career, we actually had a portfolio that was a preferred stock portfolio. And it was just all the stocks in there just were preferred, and they paid a dividend. It actually did pretty well until the dividend started to fall, and then that was the end of that. But again, being liquid. So we're going to move on, and we're going to cover Social Security as an income source. We do a lot of shows and we do radio, TV, we do all of our podcasts. We do a lot of discussing of Social Security. So just kind of briefly, give me a little spiel on your Social Security side as far as, a vehicle for income.
Yes, I mean, Social Security, again, you pay into Social Security via a tax your entire life during your working career. So, the more you pay in, the more you're going to get out. So basically, the higher your income, the more Social Security benefits you're going to get based on the age and when you draw and all that kind of stuff. So, Social Security, they say, it's a guaranteed income. I think some people rely too heavily on Social Security and don't plan for other sources of income because, like we've talked about, there's going to be some changes coming down the line with Social Security. But the biggest thing you have to figure out with Social Security is when to draw it. And that's where we really come into play. There's not a one-size answer, a one-size-fits-all for everybody out there. So, whether you draw at 62 or 70 or somewhere in between, it's going to fall back to what other sources of income do you have? What other assets do you have? How long do you think you're going to live? Do you need the income? Do you have a tax plan set up? So there's all of these factors that help you kind of figure out when the best time to draw for you is. Actually, just ran across a situation where some folks retiring and they want to retire at 62. They weren't quite ready based on the assets that they had. So I said, okay, to fill the gap, we're just going to start Social Security at 62 because they didn't want to work anymore. And when you don't want to work, it's hard to clock in every day. Mm-hmm. So there's so many factors that come into play. You have to pick the one that's best for you. Don't listen to your friend at church or the bar or the park. It's so different for everybody. And saying give your quick spiel on Social Security is kind of difficult because there's so much to get into. But just make sure you sit down with a professional and figure out the best game plan going forward.
Yeah, I think a lot of times there's two different things to talk about. So there's the numerical, this is when you should draw Social Security based on the numbers. And I think there's the emotional, right? Mm-hmm. So you don't want to work anymore. You have different questions, concerns, and is it the right time to take it, or would you rather wait longer?
Emotionally coinciding retirement with drawing Social Security, which can be a mistake. And it's really interesting because a lot of the planning that we've done, now I can speak from several people I've met with recently that we've delayed one Social Security to get the other one to get a higher amount, and then there's different reasons. Usually the one that we're delaying is the bigger amount, which may sound counterintuitive, but we want to grow that bigger because if the other person's spouse passes, then that whoever's the surviving spouse is going to have the higher one. It's going to be much bigger.
Right.
So there's a bunch of reasons for it. The bottom line at the end of the day, Social Security is not completely going away. If you're drawing Social Security, I doubt they're going to change much of it. But for somebody who's not drawing Social Security, I think that you have to be prepared. You have to really be a saver. We have to really focus on saving for ourselves because Social Security will look different for us, I think, is a realistic one. And then we'll end the show on pensions. I don't think there's a whole lot to get in depth on that, other than, I think you look at it, and if there have an option to be able to roll out your pension as an IRA, you have to really look at all the options that are available. We were talking about, 401ks, and the 401ks, actually, they offer a lot of options. Nobody's really adopted the ones where the income riders, they can actually do that, but I haven't seen one yet do it. But pension, Matt, you want to
Yeah, so with the
on
pension, you have a fixed amount of money, and they're telling you you're going to get so much per year when you retire. Now, a lot of times with a pension, whether it's through the state or it's a private employer, they'll give you the options of you can either take X amount lump sum, and a lot of times it's based on your retirement date, obviously, or you can get so much per year based off your life, based off you and your life's, or you and your life's or your spouse's lifetime. I can't talk.
Yeah, that's right. I can't sometimes either.
But as always, what I always say is get the paperwork from them. And there's two main things to remember. Number one is we talk through the options with you to say, all right, here are the pros and cons of all the different scenarios. Let's pick one that's right for you. And then the second thing I always say is there are very strict timelines a lot of times when you retire to make sure that you file the paperwork to get those funds moving. If not, we've had where they move to a second company where it just takes longer to get it. So just be aware that there are timelines associated. And again, you bring the paperwork in, we can talk you through exactly how that works.
I have one sitting on my desk for somebody coming in August.
There you go.
So there you go.
And I think just to add on to what Matt said a little bit, the biggest thing is figuring out what is the best option for you to select. I just had a couple come in, and without talking to me, they actually filled out the paperwork, which is kind of cool. Usually you don't see that. But they had the single life payout 180 payment guaranteed option selected. So basically what would happen is as long as the spouse who has the pension was living, it would get paid out. And then if they passed away, there would be a guarantee of 180 payments. And I said, well, hold on for a second. If we selected the joint 100% survivor and 180 payments guarantee, it was only like $100 less a month, which is crazy. So basically now the spouse who owned the pension will get that payment forever. If that spouse passes away, the other spouse will get it forever. And if both spouses pass away, somebody is going to get that payment for 180 payments for only $100 less per month.
Worth it.
So you definitely have to make sure you understand all of the options before you turn that paperwork in, because once you turn it in, it's really hard to change it.
Pretty much impossible.
Yeah.
So the only other thing I wanted to mention is that with the pension, as we wrap this up, this episode up, is that they are affected by interest rates. So the higher the interest rates are, the lower the lump sum will be. So just be aware of that. And it also changes that cost to be able to have the joint.
Okay, one more thing.
Yeah, one more thing.
So based on that, you was talking about investments. So there's a very common pension around here. I won't give the name out, but basically you can have it invested in the variable account or the fixed account. So basically, if you're getting close to retirement, you may want to look at different for everybody. You may want to, if you're in the variable and we have a good year in the market, a good run up, you may want to change it to the fixed account so the value can't go down anymore. And usually you can only do that once in a 12-month period. So that's another thing to watch.
Okay, very good. Well, thanks for joining us. And if you have
more.
If you have any questions on any of these income vehicles, you can give us a call at 715-341-8899 or visit us on the web and schedule time to meet with either Matt, and Victor, or myself. And we'll see you next week.